SoFi is down around 27% just year to date, and in fact just yesterday this is down negative 15%. So is this a company that is now a very strong undervalued buy, and why exactly did this company crash yesterday? So today we'll find out. We'll also look at their income statement, we'll look at their top line revenue as well as their bottom line net income over the last few years. We'll also discuss how they did get their first ever profit beat just in that latest quarter. We're going to take a look at the health of the company, their total cash versus their total debt. And as always, we want to see how they're performing against some of their competitors over the last few years. We'll take a look at some very important financial metrics. We'll look at their free cash flow per share. We'll look at some of their top line growth in percentage format. And we also want to touch upon exactly why this company has been slammed. Are there any issues we need to be aware of over the next few months and years? And really what we want to understand is, even though this stock is down nearly 70% since 2021, is it a strong buy now? And don't forget, as always, we run these companies through the valuation model, getting to our intrinsic value as well as our acceptable buy price given that investor margin of safety, and look towards Wall Street to see what they're forecasting over the next 12 months. Now in today's particular episode, we also want to take a look at 3 different rates. We want to look at a low forward-looking growth rate, we want to look at a medium growth rate and a high growth rate, just to set some expectations over the next few years, and more importantly get to that intrinsic value. So let's start off by looking at their historical performance. Now we can see they are trading around $7.27. Over the last few months, as we can see, they are down negative 27%. Over the last year, however, they are up around 8.8%. And if you want to look at when this company was listed at that price of around $10 to $11 in December 2020, it did reach a peak in essentially 2021 at $26, and now it has come down all the way to that price of $7.27. Now on the forward PE basis, it is currently trading at 106, and we do see the market cap at $7 billion. So let's dive into the numbers and see whether or not this is a very strong buy now, and exactly what those issues were over the last few days. So in terms of the top line, what we like to see, typically 3 to 7% growth for steady, moderate growth forward looking. But for other companies, tech companies, we do want to see some stronger growth. Now, in terms of their numbers, December 2019, 443 million reported on the top line. Their latest annual report, December 2023, 2.1 billion. So we can see their top line has increased very rapidly, more than 5 times, in fact, or around that 5 times level over the last 5 years. And we can see on a granular level increases every single year, which is very positive to note. Now, a little bit disappointingly on the bottom line, when we look at that net income, what we can see, the brackets signify a loss. So they've made a net loss over the last 5 years. We can see, in fact, the loss has increased from negative 240 million to negative 301 million. So not the greatest news. Whilst their top line is increasing very rapidly, we are seeing their bottom line over that longer period increasing that net loss. Now, the one thing that is very positive to take is from their latest quarter. We can see that SoFi soars after their first ever profit beat estimate. So for that quarter, the analysts were looking at a negative number, but we see they posted profit of 2 cents per share in Q4. And when we compare that to essentially Q4 of the year before, there was a loss of 5 cents. So that was very positive, and in fact, analysts were expecting them to break even per share basis. It wasn't a loss they're expecting. So nonetheless, very strong. They do have that profits of 2 share to show. Now, in terms of the forward guidance, which did look very positive, they expect bottom line net income. Now, remember that net income between 95 million and 105 million for full year 2024. Very positive when you consider that they did post that net loss of 301 million, as we're about to see here, 301 million in 2023. So it looks like it could be a turning of the tide for SoFi in terms of that bottom line, showing hopefully in 2024 what they expect, a net income between 95 and 105 million. So that is some positives to note there. In terms of a quick health check on that total cash versus total debt, we see the cash in equivalents have gone from 500 million to 3.1 billion. So nice to note their cash position has increased largely, now sitting at 3.1 billion. What's important now, just for a very quick health check, we'll look at that total debt number numerically and directionally. We see it hasn't moved massively from around 5.1 billion in 2019 to 5.7 bit, or in fact 5.4 billion. So relatively little movement, and we do know their cash position has gotten much larger, so fairly positive. But remember, we will look at that net debt to EBITDA metric later if it does become relevant for this company. Now, very quickly, we want to compare it to others in the consumer finance industry. We have Credit Acceptance, OneMain Holdings, as well as a few other popular companies. Now, we can see SoFi over the last year has returned around 9%. Not the greatest over a 12-month period. It isn't really what you want from any of your investments. You do want to see a little bit higher in the double digits. And when you compare it to others in the industry, we can see some strong double digits total return. Now, when we do extend that over the last 5 years, we can see SoFi, in fact, if we take it from 2021, had negative 30% or 31%. So they are the worst performing over that period. In fact, this would be the last 4 years. Now, remember, past performance is never an indicator of future performance, but it is just interesting to note in this case that other than SoFi, others in the industry return very strong performances over the 4 to 5 year mark. So some things just to think about there. Now, let's take a look at some other analysis. When we consider essentially the institutional ownership, it does sit at around 37%. We see around 200 million worth of sales outflows over the last 12 months by these institutions, but we see a lot more buying, just under 700 million over the same time period. And what's interesting to note, in fact, every single quarter, Q1, Q2, and Q3 and 4 of 2023, the institutions were buying more shares than selling, and notably in Q4, there was a lot more buying than selling. In fact, what makes up half of the last 12 months sale or buys did in fact come from Q4, as we can see. But again, remember, don't copy institutions. Add it as one lever of your research, but always do your own due diligence. Now, one thing we always do is the insider buying, insider selling, run it through that screener. We can see buys and sells, at least 100 shares over the last 3 months. Now we see Jeremy, the Chief Technology Officer, sell shares, 56,000, just under half, or in fact just over 500,000 worth of shares. But do remember that, as we always say on this channel, insider selling isn't necessarily a bearish signal due to the fact that insiders do sell for personal or financial reasons. We can note here, however, that since they sold, the share price is down around negative 26%. So always take this information with a pinch of salt. It is nice to note, but realistically what we want to find, which is a bullish signal, is insider buying. So let's take a look now at why exactly SoFi stock or SoFi Technologies stock got slammed today. A few reasons. The major one now being that they did a new debt offering, but what this article does like to explain is it may not be as bad of news as it sounds. Now, SoFi did announce they intend to place $700 million worth of convertible senior notes. However, the one thing that we don't understand or don't have the information is at what interest rate it would pay on this debt. The reason why this is a bit questionable, as much of the stock market is convinced that we are expected to see the interest rates come down in quite a big way this year. So it does question whether or not this company is strapped for cash. They do need it right away, and therefore this is why some of that bad news did trickle down to investors, in essence believing that SoFi is worried about their cash position and that they do need this cash now. Now, do bear in mind that this debt could become stock at some point in the future, and what this means as a shareholder is that your position would be diluted due to the ownership becoming bigger. So what we can also note here on the flip side, as it does mention here, they are intending to use some of that cash raised from the debt to redeem some of that preferred stock, which is costing the company 12.5% in annual dividends. So if they are able to essentially get the debt at a lower rate than the 12.5%, this could be reducing their interest costs and therefore increasing their profits. So a few different ways to look at this, but again, do bear in mind that this could, over the longer term, dilute your position as a shareholder. Now, one thing before we look at those financial metrics and get into the valuation, the big question here is, it's down nearly 70% since 2021. Is it a strong buy now? So a few things to note with this company. It did hit a massive major profit milestone, as we did discuss earlier. That essential profit wasn't something that the markets or analysts were expecting. They were expecting this to come in at essentially break even. Now, this is a company that could continue to generate double-digit annual growth revenue for a lot of years to come. And again, we can look at those double-digit increases to their top line over the next few years and how historically it has performed. Some strong points to note here essentially is that half of their top line comes from lending, and what is very nice to note about lending is that it did grow 21% year over year, and as it mentions here, this is SoFi's bread and butter. On top of that, their tech segment revenue grew 12% in 2023, so there are a lot of catalysts for this, and we can note that one of the most important catalysts for their expansion over the next 5 years is their financial services division. So 115% growth in 1 year, very, very strong for that financial services. And although it is essentially less than 1/3 of the size of lending, it could be one that does really increase their top line and maybe take over their lending, which is more than half of their top line. So let's jump into the financial metrics. Let's take a look at this company. Now, we do prefer to look at the free cash flow per share, and what we can note is over the longer term, it has been essentially negative free cash flow year on year consistently other than 2018. Positive to note though, in 2024, they're expecting this to be positive 41 cents, and this is important as this will take place some of that valuation that we're about to run through and how we get to the numbers for the essential intrinsic value. Sales growth as well from 2019, we see double-digit strong growth, which is very positive. As we ran through, this is expected to continue over the next few years, especially with lots of catalysts, including their financial division, just solely up 115%, which really did help them get into that profit that we did see for the latest quarter. Now, in terms of their sales, also very, very strong. It has been growing as we did analyze 2 billion or just 2.1 in 2023, growing from 2018's 270 million. From that point, very strong, consistent increases. ROE, now this is something that we look at for banks' return on equity. We can see whilst it is negative due to that essential net loss that they have faced over the last few years, it has started to improve. It has got better from the negative 12% in 2019, negative 5% in the more recent year, moving in the right direction, and we should be expecting in 2024 a positive number, given that one, they are expecting that bottom line to be a profit of around 95 to 105 million, so lots to like there. Now, we do have the free cash flow margin. As we can see, we did discuss the free cash flow per share. Net debt to EBITDA, essentially the earnings before interest, tax, depreciation, amortization, does give us some insight into the strength of the balance sheet. And what we can see here in 2023, it would take them 5.03 years to pay off all of their debt net of cash on hand. Very nice, in fact, to note that it is expected to come down to 3.82 in 2024. So that is a positive sign for SoFi Technologies. So let's jump into the valuation of this company, and as always, we typically like to run through the different models. We have the Graham's valuation, the multiples valuation, the dividend, and the DCF. Now, this is the only one really that we see is appropriate for SoFi Technologies, and what we can see, the discounted cash flow, we have the free cash flow year on year. One thing to note here is it is negative every single year over the last 4 to 5 years. But what we are expecting, based on analyst estimates of 395 million in 2024 on the free cash flow, we've then used those estimates to get to our value. So we've gone for what we essentially believe to be the low growth rate of 10%. And our growth rate, then we're using our discount rate, we get the present value of future free cash flows and terminal value. We add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, to get our intrinsic value of $9.70. Again, we have that sign of undervaluation. Although do bear in mind that we are also going to look at the other two, medium and high. However, for us in today's episode, we have gone for what we believe to be the low estimate. So we then move on to the medium, which we expect to be around 12%. And what we can see is this then gives an intrinsic value of $11.29, showing upside of 51%. We then look at the high aspect, which we can see around that 14%, coming to around $13. And as we can see, if that is what you believe over the next 10 years and beyond, you have upside of 74%. Now, bear in mind, these are just estimations, and if you do grab a copy of this model, which you can click on the pinned comment below, you can run your own numbers through, whether that's for SoFi or for other companies in your portfolio or on your... Essentially, what the value for today's episode, it comes to around $9.70. With the current trading price at $7.50, as always, we use a 10% margin of safety, which we use if we believe it has a wide moat, strong financial metrics, and good forward-looking data. If you believe that, it is a buy up to $8.73. At 15%, it would be a buy up to $8.24. At 20%, around $7.76. And at 25%, it isn't quite there yet. So we see between a 20 to 25% margin of safety for SoFi Technologies. In terms of Wall Street and their expectations over the next 12 months, well, they have upside of 27%. They believe this to be a strong buy with a price target of $9.50. As always, let me know your thoughts. This is quite interesting now. This could be a very strong catalyst, not just their financial division growing 3% or triple digits, but also the fact that they have now turned a profit in the latest quarter. They now expect the full year of 2024 to be net income around 95 to 105 million. So it could be a real turning point. It could be a great time to buy or at least consider and add it to your watch list at the bare minimum. As always, let me know your thoughts in the comments below. If you enjoyed today's episode, smash that like button, hit that subscribe and bell button, and as always, we'll see you on the next one.